Hi everybody, this is Alan Ellman, the Blue Collar Investor. In today's video, we're going to discuss fundamental ratios. In particular, the PE ratio, the PEG ratio, and the PEGY ratio. Now, I'm always getting questions regarding the PE of a stock, so I thought I'd address that along with these other statistics in today's video. Many years ago, when I started investing in the stock market, anybody who would buy a stock would first ask the question, what's its PE ratio? You wouldn't buy an equity without knowing that information. The thinking then was, the lower the PE ratio, the more fairly valued the stock, the cheaper the stock, and the better the chance that it would appreciate in value. So let's first discuss this PE ratio. It compares the price of a stock to its per share earnings. The equation is PE ratio equals the price per share divided by the earnings per share. Now that earnings information can either be trailing or past earnings information, or it could be forward or projected earnings. What the PE ratio does not factor in is the growth of a company. And that's important because institutional investors are generally willing to spend a lot more money for a company that's growing rather than one that isn't. So we'll talk about the PEG ratio, which does factor this in just a moment. Now, regarding the growth, if the PE ratio equals growth, then that's considered a fairly priced stock. Now, where do you get information on the PE ratio? Generally, when you go to the quote page for a stock to find out its price, you'll generally find the PE ratio on that page. And I'll be giving you a free site to go to in just a couple of moments where you can access this information. Now the PEG ratio equals the PE ratio divided by its annual earnings per share growth. So it does factor in companies that are growing, the companies that the institutional investors or the big boys are willing to spend a lot more money on. Now this growth can be either trailing, again, past statistics, or projected growth over the next 1 year or 5 years. The general thinking is the lower the PEG, the better, or the more fairly priced the stock. For example, if the PEG is 1, it's considered fairly valued. And the PEG is a much better indicator than the PE ratio because it does factor in growth. Like everything else, there are certain disadvantages to using this ratio, and I want to bring them to your attention. First of all, it doesn't relate corporate growth to growth of the overall economy. So if a company is growing at 10%, you may find that pretty good, but if the overall economy is growing at 15%, then you may feel differently about that particular equity. It also doesn't factor in inflation. Now, if you're using forward earnings per share growth, those projections may not be accurate, so you have to be careful of the sources you use to access this information. And it does not account for dividends. So we're going to discuss the PEGY ratio in just a moment, but companies that are not growing growth companies, but yet may have extra cash on hand, will not use that cash for research and development as many of the growth companies might, but rather instead distribute this cash to its shareholders in the form of cash or additional shares. Now, the advantages of the PEG ratio is that it's more accurate for growth companies. In essence, it levels the playing field. And it allows us to compare companies in different industries. You know, for example, if we're looking at tech companies, that's very different than looking at companies, let's say, in the food industry. So using the PEG ratio will level the playing field among the different industries. And once again, the PEGY ratio will factor in dividend yield, and the equation for that is the PEGY equals the PE ratio divided by expected earnings growth plus dividend yield. Now, where can we get this information? Well, there are many free sites where you can access this information. One such site is finance.yahoo.com. Just type in your ticker symbol and hit Get Quote. That will take you to another page. And if you look down the left-hand column under Company, you click on Key Statistics. And that will take you to the page that you see on the screen right now. And you see two examples of the information I've been discussing. On the upper left in red, you see the PEG ratio based on a 5-year expected growth rate is 1.15, which tells us that it is a fairly priced equity. And on the lower right in green, you see I've circled the forward annual dividend yield. You see a dividend yield of 1.70%. So if you were so inclined to figure out these ratios, you would have that information regarding the dividend yield on this particular stock. Now, the good news is, if you use the BCI system, you don't have to sit back with pen and paper in hand and start figuring out these ratios, although I think it's important that you understand them, because as blue-collar investors, everything is all about education, motivation, and ultimately becoming CEO of your own money. But the fundamental information is inherent in the system screens that we use. The IBD 50, which was formerly the IBD 100, actually just changing as I'm creating this video, consists of the following fundamental information: return on equity, earnings per share rating. How does that company's earnings per share growth compare with other companies? Annual earnings per share percent change, last quarter's earnings per share percent change, next quarter's earnings per share percent change, and finally last quarter's sales percent change. Very, very thorough in terms of fundamental screening. Then we go to the Smart Select ratings. Here we have the EPS, earnings per share rating, which compares the company's current and annual earnings per share with other companies. Once again, we accept only the green, the ones performing at the very, very top. It also compares the most recent 2 quarters with the 3 to 5 year annual growth rate. So we want to make sure that there's a lot of positive momentum going on regarding growth in these companies. We also look at the Scouter rating, which takes 10 years of historical data, much of which is fundamental in nature, and identifies the qualities that have proven statistically to be predictive of stock performance in the past. We accept a rating of 5 or better. So as you could see, regarding fundamentals and fundamental ratios, the BCI system has all bases covered. So I hope you found this video useful and helpful. I look forward to hearing from you down the road. You can contact me at alan@thebluecollarinvestor.com, or visit my website, which has more information on these subjects and much, much more, at thebluecollarinvestor.com. Thanks for listening. Take care, everybody.